Our next guest, well, he predicted this move in Treasury yields. Jeffrey Gundlach is the founder and CEO of Double Line Capital, overseeing $123 billion in assets under management. Joins us now exclusively from Los Angeles. Jeffrey, good to see you again.
Good to be with you again, Judge.
Always good to have you. 6 down days now in a row for the S&P 500. What's this about? Why are the markets suddenly unsettled? Is it all about rates?
It's partly about rates. I mean, obviously, we talked about this before, that there was 4 years in a row, basically, that the 30-year Treasury bond was bumping up against resistance at about 3.25. And I think when we were last together, we were talking about this before, and it held up at 3.25 or so several times, including earlier this year. But then I always felt that if it broke above that, we would start looking at yield curve steepening, and we'd see an acceleration of higher rates. So I think it's pretty clear that part of the issue here is the rise in rates and also the speed with which it went up, which isn't all that surprising. I mean, once we got above 325, we tacked on another 20 basis points really quickly. But there's an issue that's been developing for several months now that I think doesn't get enough attention, which is also part of the issue, and that is the fact that the U.S. stock market, since January 26th, has acted uniquely strong compared to the global stock market, including everything except the United States. It's a really fascinating chart. I had it in my webcast a month ago, and I was pointing out that that was a really strange divergence and one investors needed to pay attention to. Basically, what happened, Judge, is the U.S. stock market, and compared to the entire global stock market, excluding the U.S., went up in tandem about the same amount and with the same pattern from the year-ago period into January 26th of this year. And if you normalize the lines so that they both meet at January 26th, it's really interesting because they fell together. The U.S. and the world stock market, ex-U.S., fell together into that February mini-crash, and they fell the same amount. And then they rallied back up together about the same amount. And then they fell back down together about the same amount. But starting in about June, something really strange started to happen because for the months before, they were acting identically. But starting in June, the S&P 500 went on a solo journey to new highs. It actually went up about 12 to 15% above the point that it was at in June when the U.S. stock market and the non-U.S. global markets were basically at the same starting point. However, at that same time that the S&P was going to a new high, the global stock market, ex the United States, went down. And it went down to the low of the 12-month period, and it went down about the same amount that the S&P 500 went up. So you had this alligator jaws divergence on the chart that was really, really interesting because one market, the U.S. exclusively, went up by about 12 or 15%, and the global stock market, ex-U.S., went down. And I said in my webcast, I think that if the global stock market heads lower still, that there's no way the U.S. stock market can hang in there because the divergence is just too big. And if the global stock market is really going to take out the low and put in a new low, something bad must be happening. And I don't think the U.S. can hold in there. Well, what happened as rates broke to the upside on the 30-year, the global stock market ex-U.S. did take a new leg down and did go to a 12-month low. And so it's interesting that the S&P 500 did what I said it would in my webcast, and that is join the global stock market on the way down. Also, maybe one more factor that's going on is there's a couple of stocks, particularly Amazon and Apple, that are responsible for massive gains here in 2018. And it just might be that once this market started looking a little shaky, it just might be, now that we're in the middle of October, that some investors might be taking profits, thinking about year-end. I mean, back when I started in this business, we talked about year-end tax selling. We talked about that in December, and then started to migrate into November about 10 years ago. And it seems to be getting earlier. So it's just possible that this weakness has encouraged some selling because you still have enormous profits in Amazon, even though it's down substantially from its high.
Right.
And Apple is pretty much almost on its high. It's hardly down at all. So that might be vulnerable to some tax selling as we move in the few weeks ahead.
So let me ask you this. You mentioned the speed in which rates have gone up. Was it faster than you thought? And it also, does the fact that it went up in the manner at which it did lead you to believe we're closer to the end of this recent move or merely getting started?
I think it's more like in the middle of the move. What I expected is that when we got to 325 on the 30-year, if we broke above it, it would probably break above it with authority. And it sure did. I mean, that one day that it broke above 325, I think the long bond dropped over 2%, 2 points that day, and there was a rout across the entire yield curve. And that was followed by weakness the next day, and then another acceleration, which I expected, up to around 344 or so on the 30-year Treasury. That makes sense to pause there. But if you look at the charts and you look at the way the market's behaving, and you think about the trends that are underneath the bond market, it wouldn't be surprising at all to see the 30-year go to 4%. Before this move of the breakout above 325 is over. And the curve should probably steepen. So maybe the 10-year Treasury makes it to 350 or 360 during that move. One of the things that is really fascinating about this sell-off in bonds is it's happening in the context of a really high short position against the Treasury market. It was actually by far the highest ever on the data series, not by a small amount, by a very large amount. And with this sell-off, you'd have thought that maybe it would be braked a little bit by all of that short positioning, maybe looking to take profits, because rarely do you have this kind of crowded positioning in a market, and they're all making money on it. So that was really interesting. I think one of the reasons that people are comfortable staying short the bond market, number one, obviously the Fed wants to tighten. And, you know, ultimately, if the short rates go higher, that creates competition because the spread isn't very big. But also, investors are starting to realize just how many bonds are coming at us in the year and two ahead. And I've talked about this repeatedly over the last couple of years. We had a budget deficit in the United States that went up from around $600 billion a couple of years ago to now the official number for fiscal 18 is a little over $900 billion. But that doesn't really capture how much debt is really being added to the national debt in the United States. Because if you just look at the deficit, there are certain things that aren't included in there. Importantly, there's a loan to the Social Security system that is a very big number, and it takes the increase in national debt for the fiscal 2018 is not $900 billion, it's $1.271 trillion. And that's a cash accounting way of tracking the growth in the debt. If you use accrual accounting, which companies have to do when they report their financial situation, they have to accrue things like pension liabilities. Well, we have pension liabilities in the United States, too, like the veterans benefits and so on that have been increased. And back a couple years ago, we don't have data for 2018 fiscal yet, I don't think. But a couple of years, the 2 years before that, I think we had about $400 billion of accrual that is obviously going to have to be borrowed in the future at some point for these liabilities. So in essence, the actual growth in liabilities is more like $1.7 trillion in the United States. And on top of that, you have the Fed now cranking up quantitative easing to $50 billion a month, which is another $600 billion for fiscal 2019 if they continue on that course, which takes you to around $2.25 trillion of debt increase, Judge. And this is at a time where we're supposedly in a good economy. GDP, real, was over 4% in the second quarter. It might be in the high threes for the third quarter. And here we are, we're supposed to be having a surplus, and the deficit is expanding. Ladle on top of that, the debt to GDP ratios in many other developed countries, and ladle on top of that, $10 trillion per a McKinsey study that came out about a month or two ago, that global corporate bond maturities are something like $10 trillion over the next 5 years. So there's a kind of a problem with the compounding curve on debt service, and I think that people are starting to realize that we're going to have to take down an awful lot of bonds, and we're getting more isolationist in the way we're dealing with things, and maybe we won't have our foreign creditors continue on with their willingness to accept our bonds at these levels.
So let me ask you that.
Of yields. Maybe they have to go higher.
Let me ask you about that.
Sorry, Judge?
I just want to ask you, do you think Powell is too hawkish? Do you think that he was too hawkish last week? Or do you think that the market got it wrong? And then I want to ask you about the president throwing the Fed, Powell and everybody else under the bus. But first off, was he too hawkish last week? Is the Fed on the wrong path?
I don't think so. I mean, all the inflation measures are really on the core basis at 2% or higher. I think core CPI came out today at around 2.2%, which is a little bit above that 2% target. You remember in the old days, they were trying to get inflation up to 2%, and that was supposed to be like a ceiling. and then it became kind of like a target, and now we're supposed to be kind of symmetric around it, meaning that because we were below 2 for a while, now I guess you've got sort of a payback that's okay to be above 2. But with yields only at about 2.85% on the 2-year, and the headline CPI up in the mid-2s, I'm not sure I could say the Fed is really being hawkish. I would say that maybe the problem is that the Fed was far too dovish for far too long, keeping rates very, very low, and now they're kind of trying to make that difficult journey getting back to a so-called normal rate. I thought the Fed statement was really weird when they dropped the word accommodative, because it seems to me you're either accommodative, neutral, or restrictive. And when the Fed says that the neutral rate is far higher than where we are today, well, then I guess you're not at neutral and you're certainly not restrictive, so I guess you must be accommodative. But oddly, they dropped that. When it comes to President Trump, it's pretty clear to me that he's being kind of crazy like a fox with this Fed rhetoric, where he doesn't want to take the blame if the Fed over-tightens and leads to a problem in risk assets, which, is started to come out in real time in the last week or so. So he's basically saying, if the market goes down, it's on the Fed. And so you can't blame President Trump for the stock market decline. I mean, that's what he's coming from. But ultimately, we've gone back to old school methodologies by the Fed, where in the old days, 10, 15 years ago, they would tighten at every single meeting once they got into autopilot mode. Now it's more like once a quarter is the autopilot mode, but they're going to keep tightening as long as inflation stays above 2%, as long as the markets don't throw too big of a fit, and as long as the inflation rate is, in that mid-2s, I can see the Fed continuing to tighten. We're in the place now, that autopilot place, where you need the data to change to the downside to change the Fed's mind. And right now, it's too premature for that. Leading indicators are super strong year over year at 6.4. The sentiment surveys on some measures are off the charts. CEO confidence and homebuilder confidence has flagged a little bit, still at a very high level. You would really need those things to drop in an observable way, along with things like the PMI indices. Junk bond spreads would really have to start widening much more than they have already to be really concerned that there's already something that's broken in the economy. So the Fed's likely to stay on that path.
Well, it's clear the president's probably looking for some political cover, too, if this stock market sell-off gets a little bit worse. But what do you think when he calls out the Fed the way he does over the last 24 hours, including just before we came on the air together today?
Yeah, I don't know. I think it's kind of a myth that the Fed is really all that independent. They say that they're independent, but they're constantly, I think, having discussions about what's going on. President Trump is just a different kind of guy. The fact that he is calling out the Fed, he calls out everybody. So it would be completely out of character for him to not try to point fingers and lay blame at other people's feet. He does that all the time. So I'm not surprised he's doing that. I do notice, Judge, that the administration has counterbalanced some of that rhetoric by trotting out Larry Kudlow, saying, yes, the Fed is independent. And I think he used the word something like Powell is on target, meaning that he thinks that it's just fine. So you've got kind of on the one hand, you got President Trump with his rhetoric, and Larry Kudlow's there to kind of calm it down.
Right, but how much do you think of what we're seeing is self-inflicted from the trade policy and tariff causing inflation that may be still on the come? You got commentary from so many big companies, FedEx, Macy's,
yes.
Ford, Micron.
Yes.
I go down the list.
Yes, exactly. And I think that is not a coincidence that a lot of that rhetoric came out while the bond yields were starting to push to that breakout point. I mean, it really is clear that tariffs are in the short term. I mean, maybe you have a long-term strategy that it sounds pretty illogical, but by ramping up tariffs, you're going to eliminate tariffs. Maybe that's where you're trying to get to with this strategy. But along the way, it's clear that you're going to be raising prices. And I thought that 1-2 punch of a Ford senior person saying, if we have to have certain rules now, regulations sort of on higher input prices for car parts, obviously we're going to have to raise the prices of our cars. And tariffs are inflationary. One thing that's strange about, you talk about self-inflicted, one thing that's strange about the administration is on the one hand, they praise tax cuts as being a wonderful thing when they're for corporations and for the middle class. But at the same time, they're raising taxes. Tariffs are a tax. The Chinese don't pay the tariffs. American consumers pay the tariffs. And so if you're increasing the cost of cars, that could easily be sort of an inflationary signal. And at the same time, Amazon made that statement they're going to increase their minimum wage to $15. I think that puts a kind of a structural cost boost into a lot of companies' businesses. I think Amazon's doing it in a fairly clever way. I think all they do is automate more, and they're making it much higher barriers to entry for their competitors if they're forced to kind of follow suit, follow the leader, and raise their minimum wages as well. But obviously, that is also somewhat inflationary. Meanwhile, inflation is going to be a little more stable for a while. We have a model at DoubleLine that's been very accurate. We expected the CPI core and headline to drop this month. It should be fairly stable into year-end, in the low 2s for core, maybe a little higher,
right?
And pretty much where we are for the CPI.
Yeah,
but we have indicators.
CPI was cool. It was cooler this morning. I mean, maybe we need to take a chill pill on the inflation thing.
But we expected that. Yeah, we expected that, but at the same time, we have forward-looking indicators on core inflation at DoubleLine, pretty much all of which corroborate the idea that core inflation in the next year and a half to 2 years should probably move up into the high 2s, all things being equal, and these indicators don't even know that there's tariffs coming. These are using historical relationships. So one thing that works is the New York Fed's underlying inflation gauge leads core CPI with a correlation of 80%, which is very high over a multi-year period, by about 16 months. And that indicator suggests that core CPI should be headed into the high 2s. Also, you can use the PMI surveys to have a forward look at core CPI, and that also correlates with almost 80% with a 21-month lead. So these are very high correlations. And the PMI also suggests that it's plausible, if not likely, to expect core CPI to be moving into the high 2s, which would mean, if that really happens, that means that for sure the Fed will stay on this course.
Right.
And that's going to be really interesting to see if the bond market can absorb that, because with this deficit exploding the way it is, and it's going to get much worse with the compounding of the entitlement programs, the cost of servicing our debt is going to increase. In the next 5 years, there are $7 trillion of Treasury bonds maturing over that period, and they're paying an average coupon of about 2%. So when that gets rolled over, what if rates are at 4%? That means you're going to have another $140 billion of excess debt servicing costs per year. So this compounding curve of debt, I think, is going to be getting a lot more attention as we move forward, and these numbers get more and more real time. In the last few months, almost every month, the estimates of the federal deficit have come in on the low side, and the actual was much higher. And that's a trend that somehow seems likely to continue.
So let me ask you this. You've said on Twitter, and this is your word, that stocks were, quote, buckling because of what was happening with rates. If they do, in fact, go to a 10-year of 350 to 360 and a 30-year to 4%, or anywhere closer to those levels, what do you think happens to equities?
They go lower. I think equities go lower if rates go higher, particularly if rates go higher in a way that people seem to be alarmed by, which is kind of what happened in the last week. I mean, there are 3 sectors of the economy that have already seemed to have been affected by rates. We have a major bear market underway in homebuilders, and there's no surprise there. I mean, we've had big increases in home prices, far in excess of average hourly earnings growth and income growth over the past 7, 8 years or so. And we have interest rates that are up by 200 basis points on mortgages. And when I hear people on financial media say it doesn't matter because rates are still low, that's nonsense. It's the delta that matters. When you've had 3% and lower 30-year mortgage rates for several years in a row, obviously the pricing structure of the housing market has that factored into its construct. And now we have mortgage rates at 5.1%, possibly going to 5.5%. That would be almost a doubling of mortgage rates. And we all know that mortgages is a monthly payment kind of a game. So if the rate is higher, no surprise that we see declines in home builder confidence, and also the University of Michigan survey that says, is this a good time to buy a house?
Okay.
Also, autos are in a bear market, and banks are doing terribly because the loan volume is likely to shrink as we see interest rates going higher, because it's difficult for people to afford higher rates from this level.
This whole thing of rates rising for the right reason, you don't sound like you buy that.
That just seems to me to be an empty platitude. I don't even know what that means. They're rising for the right reason.
Well, I mean,
rising
they've been so
is
low
rising.
for so long. I mean, the economy is doing really well. It's ludicrous to have rates as low as they were this late into the cycle.
I agree with that, but before we get all excited about how well the economy is doing, let's think about a couple of things. We've increased the deficit by about 1.5% of GDP. So it shouldn't be that surprising that GDP is up by about 1.5% because part of the equation for GDP includes the delta in government spending, in this case, government borrowing. So it's not that surprising that we moved up to kind of more of a 375 type of economy from a 225 economy because we've sprinkled Miracle Grow on the plant and it's having the steroidal effect that you're wanting. Also, this nonsense about this is the greatest jobs economy in history. If you take a look at the last 20 months of Obama's administration, non-farm payrolls averaged 211,000 per month in the last 20 months of Obama. In the first 20 months of Trump, non-farm payroll growth per month averaged 190,000. Last time I checked, and I'm a math major, so I might have some credibility here, last time I checked, 211 is higher than 190. And if you zoom back and take a look at non-farm payrolls back to 1940, this is anything but the highest jobs economy, especially if you adjust per capita. It's kind of the same that we've had over all of those decades, but the population has grown since 1945 by 250%. So on a per capita basis, those jobs aren't there. Also, it's just not true that we have tremendous wage growth. If you just look at the charts, it's just not true. We're about where we've been. So it's true that leading indicators are good. Part of that's the stock market. It's true that confidence is there, you know, but it really, the economy can be explained by being kind of tax-based and spending-based, tax cut-based and increased spending-based, and the delta isn't going to be there in perpetuity, and higher rates with quantitative tightening cannot be positive. One of the fascinating charts, there's two charts that are really interesting about stocks.
I got less than 30 seconds.
Okay, one is the growth in national debt exactly matches the S&P 500's performance back to 2009. It's really interesting. The last one is the balance sheets of the central banks increase exactly the same, if you look at the chart, as the growth in the global stock market. And now those balance sheets in accumulation are going down. So it's not surprising that the global stock market is going down. And away from the U.S., this is not a good year for stocks at all.
Yeah. We'll leave it at the last word. Actually, you know what? You predicted the presidential election right. Who's going to win the midterms? And then I got to run.
I think the Republicans keep the Senate, and I think the Republicans do better than what they're polling, but lose seats in the House.
All right. Jeffrey, it's always good to catch up with you. Thanks for your time and a good amount of it today.
Thank you, Judge.
All right. Double Lines, Jeffrey Gundlach joining us exclusively from Los Angeles. Thank you so much for watching. That does it for us. Power Lunch begins